Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Private Equity Investments, a modern investor's guide. The role of private equity firms. Private equity firms are like the architects of the business world. They invest in companies with the aim of building them up and eventually selling them for a profit. But how do they actually do this? Let's break down their role by exploring how they structure their funds and the strategies they use to add value. Fund structure and management. Private equity funds are typically structured in a way that might remind you of a team sport, where each player has a specific role. There are general partners, GPs, and limited partners, LPs, each with distinct responsibilities. General partners, GPs, these are the folks who run the show. They are responsible for managing the fund, making investments, and working with the companies to increase their value. GPs usually have a lot of experience and expertise in the business world, and they use this to make smart investment choices. Limited partners, LPs, think of them as the fans in the stands, providing the money but not the play-by-play management. LPs are typically institutions like pension funds, insurance companies, and sometimes wealthy individuals. They invest their money with the expectation of seeing a return over time, but they don't get involved in the day-to-day decisions. This structure ensures that the people making investment decisions have a vested interest in the success of the fund, aligning their goals with those of the investors. Value creation strategies. Once a private equity firm has invested in a company, the real work begins. They don't just sit back and wait for the company to grow on its own. Instead, they have several strategies to actively enhance the value of their portfolio companies. Operational improvements. This is all about making a company run better. It might involve streamlining processes, reducing costs, or boosting productivity. Think of it like tuning up a car to get better mileage and performance. Strategic growth initiatives. Here, firms might help a company expand into new markets or develop new products. It's like giving the company a map and compass to explore new territories. Financial restructuring. Sometimes, rearranging the company's finances can unlock a lot of value. This could mean refinancing debts or changing the way equity is structured to make the company more financially stable. Executive leadership changes. Bringing in new management can sometimes make a big difference. A fresh perspective at the top can steer a company in a more profitable direction. These strategies are like tools in a toolbox, and private equity firms use them to build stronger, more competitive businesses. It's not just about buying and selling, it's about transforming companies and setting them up for long-term success. Current trends in private equity investments. Private equity investments are changing rapidly, influenced by trends in the economy and technology. Understanding these shifts can help investors make informed decisions. Here, we'll explore how economic conditions and technological advancements are shaping the private equity space. Impact of economic conditions. Economic conditions play a crucial role in shaping private equity investments. When the economy is strong, private equity firms often find more opportunities. Companies are growing, and there's more capital available to invest. But what happens during economic downturns? Here's how different conditions impact private equity. Rising interest rates. Higher rates can make borrowing more expensive. This situation might lead firms to focus on stronger, established businesses. They may also seek out industries that are less sensitive to economic shifts. Market volatility. When markets are unstable, investors often become cautious. This can lead private equity firms to target sectors that are more resilient, like healthcare or consumer goods. Government policies. Changes in regulations or taxes can affect investment strategies. Firms must stay alert, adapting their plans based on new policies that might encourage or discourage certain types of investments. In contrast, during economic booms, private equity firms become bold. They look for emerging companies and new markets. This leads to greater competition for investments, which can drive up prices. Technological innovations in private equity. Technology is transforming how private equity firms operate. It enhances investment processes and streamlines decision-making. Here are a few ways technology is reshaping the industry. Data analytics. Firms now use advanced analytics to gather insights. This helps them identify trends and make data-driven decisions. With accurate data, private equity firms can forecast opportunities more effectively. Artificial intelligence. AI is helping in deal sourcing and evaluating investments. This technology reduces the time it takes to assess potential deals. Is this a game changer? Absolutely. The speed and efficiency provided by AI tools are helping firms stay competitive. Blockchain technology. This technology can improve transparency in transactions. It allows for secure record-keeping, which is essential in maintaining trust between investors and firms. Remote collaboration tools. The rise of remote work has led firms to adopt new ways of collaborating. Tools like video conferencing and project management software make it easier for teams to share insights and work together, no matter where they are located. As technology continues to evolve, private equity firms will likely find even more creative ways to enhance their strategies. The rapid pace of innovation means that staying updated is crucial for successful investing. By paying attention to these current trends, investors can better navigate the private equity landscape. After all, understanding both the economic environment and technological advancements can lead to smarter investment choices. Exit strategies for private equity investments. When private equity firms decide to exit their investments, they have several strategies to choose from. The exit strategy not only determines how they will make a return on their investment but also affects the future of the company they invested in. Understanding these strategies is crucial for anyone involved in or studying private equity. Initial public offerings, IPOs. Taking a company public through an IPO is one of the most celebrated exit strategies for private equity investors. The process involves offering shares of the company to the general public for the first time. But what does this process really entail? Preparation. Before going public, the company must be ready. This includes ensuring financial statements are accurate and creating a strong business model. Regulatory requirements. Companies must comply with various regulations, which can be complex. They need to file required paperwork with regulators like the SEC. Market conditions. The timing of an IPO matters. Favorable market conditions can lead to higher valuations. Investors often expect a lucrative return through an IPO, but the process can be time-consuming and requires careful planning. It's like throwing a big party. If you want it to be successful, everything needs to be just right. Sales to strategic buyers. Selling to a strategic buyer is another common exit strategy. This involves selling the company to another business that sees value in the acquisition, often for reasons beyond just financial gain. Synergies. These buyers look for synergies that can increase profits. For example, a tech company might purchase a startup to integrate new technology into its products. Competitive advantage. Acquirers might want to eliminate competition or enhance their market position by acquiring a company. Negotiation. The sale process often involves negotiations. This ensures both the seller and buyer find the deal mutually beneficial. This strategy can provide a quicker exit and might lead to higher multiples compared to other options. However, it requires finding the right buyer whose goals align with the company's objectives. Secondary buyouts. Secondary buyouts occur when a private equity firm sells a company to another private equity firm. This strategy has gained popularity over the years for several reasons. Access to capital. The purchasing firm usually has access to capital, which makes financing the deal easier. Growth potential. The new firm may see potential for growth that the prior firm did not capitalize on. Efficiency. These deals can be smoother and faster since both parties are familiar with private equity dynamics. While some may view secondary buyouts as a simple transfer of ownership, they often signal confidence from the acquiring firm about the company's future potential. It's a bit like handing the baton in a relay race. The next runner has a good chance of winning if the foundation is already strong. In summary, these exit strategies offer private equity firms different avenues to realize returns on their investments. Each option has unique benefits and challenges, making it essential for firms to weigh their choices carefully. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.